From Morningstar, I'm Jeremy Glazer. There's been question marks about the future of active management, but by many measures, active managers are as prosperous as they've ever been. I'm here today with Russ Kinnell. He's our Director of Manager Research to look at this paradox. Russ, thanks for joining me.
Glad to be here.
So let's start with the prosperous question. There's been a lot of talk about this rise of indexing really eating at active managers, but by a lot of measures in terms of assets, active managers are doing pretty well.
That's right. Today we stand at $11.7 trillion in the U.S. in actively managed funds. That's the most it's ever been. That's almost 3 times what we had at third quarter 2009. And of course, the reason is that even though people are moving some money out of indexing, they're not doing it as fast as the market's going up. And so you have this tremendous appreciation. So even though on the one hand it seems like tough times for active management, it's also a great time for active management. They're running a huge amount of money. The market's really been kind to active management.
And even if they're managing that much money, fees are lower, though. They're collecting less money on that pot.
Fees are lower, but obviously in dollar terms, they're still collecting more than they've ever collected. They're still making more profits than they ever have.
But you did talk about some of those outflows, about the moves to indexing. When you look across strategies, what percentage are in outflows today?
Yeah, so within actively managed U.S. equity funds, 2/3 of funds are already in outflows. And so when you think about that, that's actually a pretty dark sign for active management because we're in a bull market. Things are great. Usually flows follow performance, and you've had really strong performance in active and index alike, and yet people are really bailing on their actively managed equity funds today, and so it's a dark sign for sure.
So if we were to see a downturn, that could get pretty ugly fast. When you look across the market, you just talked about U.S. equities. Are there other parts, maybe international equity, where we're seeing active managers hold up a little bit better in terms of outflows?
Yeah, so one positive for active management is that outside of U.S. equity, active management has still been very popular. So if you look at fixed income and if you look at foreign equities, largely they've had a lot of strong inflows. However, in the third quarter of this year, we saw that pivot. And in the third quarter, you had net outflows of $15 billion out of active equity, international equity, $19 billion in inflows to international index funds. And so it's another thing to worry about for active management because, again, if international is going to become like U.S. equity, all of a sudden they're facing another really big challenge as investors start to buy into indexing overseas as well.
In some ways, then, a great time to be an active manager, but maybe some reasons to think the future might not be as rosy.
That's right. If you think about right now, the typical fund might have, say, 20% appreciation a year and, say, 10% outflows. If instead the market goes down, we go from 20% appreciation to maybe 25 or 30% depreciation, and the outflows are going to accelerate, so maybe go from 10% outflows to 25%. So now instead of having a big victory on appreciation and some outflows, both could get worse in a bear market, and so there's definitely some reason to be concerned if you're an active manager.
Russ, thanks for sharing this today.
You're welcome.
From Morningstar, I'm Jeremy Glazer. Thanks for watching.